Warning, warning, credit rate warning. First, Fitch last night placed the U.S. AAA credit rating on negative watch. And now today, DBRS Morningstar has put the U.S. on review for a downgrade as well. Will the warnings force the Fed's hand to pause interest rate hikes? Well, at this hour, looks like the markets are saying absolutely not. Right now, Fed funds futures show about a 50% chance of a 25 basis point hike in June. That's a big spike compared with an 8% chance back on May 5th. And also back on May 5th, where there was a 75% probability the Fed would cut rates at the September meeting. Forget pause, cut. There is now a more than 60% chance of a rate hike. The guessing game has banks, particularly the regionals, in limbo because, of course, financial market uncertainty hurts them in a way outdistanced way. So let's bring in former FDIC Chair Sheila Bair, who knows just a thing or two about all sizes of banks. Sheila, are these downgrade warnings from Fitch and DBRS Morningstar, which, by the way, is the fourth largest ratings agency, going to force the Fed's hand to pause? Yeah. And if not, should they pause?
Right. Well, I don't know if the Fed isn't forced by anybody. The Fed's pretty powerful, and they make their own decisions. But I do think that they're taking a data-driven approach. And we do have, gosh forbid, a default or at least a downgrade, which presumably will push even more pressure on short-term rates. That may be doing the Fed's job for it. And to do another short-term rate increase, Fed's fund overnight rate increase, on top of, this tightening that's already going on because of this debacle that is our debt limit fiasco, I think that they would have to seriously think about that. So, yeah, a lot of it will be downgraded. Is probably, what's going on now, it's hard to see why they wouldn't downgrade. If that's going to push short-term rates up, then the Fed's going to say, well, maybe we don't need to do it ourselves.
Do you think a downgrade is right around the corner if this thing isn't settled, let's say, by Tuesday?
Yeah, well, they certainly are taking it down to the wire, and it's as you were pointing out earlier, it's really pushing up short-term rates. It's inverting the yield curve. That's even more. That's hard on banks. You borrow short and you lend long. That's hard to maintain a business model in this kind of environment. There's a lot of pressure on deposit rates already. Mm-hmm. Ironically, in the short term, there may be some positive impact. At least anecdotally, I get messages from people saying they're going to take their money out of treasuries and put it in banks because they think banks may be safer at this point. That's how bad it's gotten with this public debacle that we call our debt limit debate. So we'll see. It's just this is uncharted territory. We went through this in 2011. Mm. Ironically, for a little bit, there was a lot of turmoil after the S&P downgrade. And ironically, Treasury rates actually went down briefly because the world was in turmoil, but it was still viewed as a flight to safety. So I don't think that's going to happen again, though. I think this has been going on for so long, and people are really getting worried about it.
Well, let me just jump in here. The 2-year yield Sure. and the 10-year yield, the yield curve inversion, which for those of you who don't really understand that term, it often screams recession, but it's been doing that for nearly a year now. It's now at 71 basis points. That is how huge the gap is at the moment. What does that tell you if you sort of shift the light right onto regional banks who are very sensitive to all kinds of rate movements? And we saw one go under. That was Silicon Valley Bank, then Signature Bank, then First Republic had to be bought by J.P. Morgan because they were caught flat-footed when rates moved so high.
That's exactly right. And so that's right. So the more acutely interest rates go up, the bigger those unrealized market losses occur on the low yielding assets that banks already have on their books. And then also it increases pressure to raise the interest they're paying on their deposits, which is going to compress their interest margins. So it does create a very challenging environment for the banks. I still think that the vast majority of them are going to be able to weather this, but it's not an easy environment to be managing right now.
We had investor Kyle Bass on the other day, and he said because of, and this is something completely different, but the commercial real estate loans that many have on their books, because regionals tend to write those loans in much bigger ways, several more, these are his words, several more will go under. Where do you stand on that?
Yeah. Well, I think kind of the good news and the bad news about CRE is that a lot of it's coming due to be refinanced. So if you have a borrower who can afford the payments, they can refinance at a higher rate. But the problem is at least with office and urban retail, the vacancy rates are very high. That's a very distressed environment. You're probably going to have some borrowers that cannot pay those higher rates. So banks are just going to have to negotiate with them. So yeah, it's going to be a problem.
Well, define problem. I don't mean to push you too hard on this,
yeah,
but
no, that's okay.
Does that mean that some are going to go under?
So I think there are going to be a lot of CRE losses. I think, yes, eventually it's going to take some banks down. Will it be a lot of banks? No, I don't think so. But over the next few years, we're going to have failures. Part of that's going to be related to interest rates going up so dramatically. That plus a combination of CRE problems, especially again in office and urban retail. And then, of course, if we have a recession, all bets are off, because then you'll see, delinquencies and defaults going up across the board. Hopefully, the Fed will be able to engineer soft landing. We won't have that. But again, it just makes it so inexcusable what's going on now with the debt limit talks, which is putting even more pressure on interest rates and more turmoil in the financial sector.
What does the government need to do to fix this situation?
Yeah, well, I think they need to stop authorizing and appropriating, spending so much money. I mean, the debt limit's just authorizing debt to pay for, spending they've already authorized.
Well, that's what the Republicans say. Enough already.
Yeah, but then they need, but the debt limit's the wrong lever to use. I'm with the Republicans on spending, and actually, if we slowed spending in a targeted, sensible way, it would ease pressure on the Fed. I mean, all this deficit spending is creating excess demand in the economy that's also driving inflation. Dial some of that back. I'm really surprised the Republicans aren't using that argument. Reducing spending is a good way to fight inflation and more targeted than these brutal across-the-board rate increases that the Fed has been putting us through.
Yes, that is basic Econ 101. Spend less.
Yes, it is.
Stop throwing out so much money so demand goes down. Sheila, great to see you. Thank you very much.